So let's do a discounted cash flow on Disney. Now, when a big investor wants to invest money in a company, or even small investors like us, they usually run a discounted cash flow model to see if the company has enough free cash flow to sustain the business and grow it. So the first step, let's figure out the market cap of Disney. And it's $210 billion. You get all this information from Yahoo Finance, and it's currently trading at 116.54. So it's 1.8 billion shares outstanding. So when we figure out the future value of the company, we divide it by the shares outstanding. And obviously there's lots of different ways to analyze a company. This is just one of the most important ways to do it because you need cash to live. And some companies have negative free cash flow and they're still good investments like Tesla, but you're banking on the future of the business, the future growth. And it's kind of like investing in a business that doesn't make money. You would think, why am I investing in your business if you're not making any money? What's in it for me? And they say it's the future of the business. Well, that has to be your analysis to figure out, are they correct? Does the business have a good future? Can it grow? Will the market respond to the product? So I need the past 4 years of free cash flow net income. And you could see in 2019, they had a big drop in free cash flow. It went from 8 billion, 8 billion, 9 billion to 1 billion. So the thing with cash flow is it's actual cash. So if you buy a building for $1 billion, that's $1 billion of less cash you have. Where on an income statement, it may get amortized over 10 years. So it's actually $100 million each year in your income statement. Or 20 or 30 years it gets depreciated. So it's a lot smoother net income where free cash flow can be more lumpy because it doesn't depreciate. It's cash in and out. Revenue tends to be the smoothest because you can't really manipulate revenue. You could manipulate net income using different depreciation methods and tricky accounting. And most of the time it's legitimate. Companies aren't doing anything unethical or illegal. It's just the way they set up their accounting. In the long run, it has to all add up. So you can see their revenue has been pretty much growing each year for the most part. It went down a little from 16 to 17, but so that's a good sign for an investor. Although during coronavirus, you may feel their numbers are going to drop dramatically, which I'm sure they will. But will it come back? Will business come back by 2021, 2022? That's what we have to kind of figure out, which is the hardest part. So we're going through the capital structure because we need to figure out how much to discount the free cash flow by. So we want to figure out how much debt they have, and the current debt is debt due within 1 year. And they have 3.8 billion. And then long-term debt due beyond 1 year, which tends to be a lot bigger. It's 27 billion in their case. And I took the interest expense from the income statement already. They pay $1.2 billion on the debt. So they pay 3.93% interest on the debt, which looks about right. That's a number I would expect Disney to pay. Now we have to reduce the debt by their effective tax rate. So let's take their interest expense. Now their income before tax. I need your income tax. Took the wrong number. Got to make sure you do the correct number. Income before tax. Okay. So their income before tax is 13 billion. And their income tax is 3 billion. So their effective tax rate is 21%, which looks about right. I would expect around 20%. So that looks right. So even though they pay 3.93% interest on the debt, that gets discounted by 1 minus the effective tax rate. So they actually, the cost of debt is 3.08%. And let's figure out the cost of their equity. We need their beta. I would imagine a beta would be pretty close to 1 since they're a stable company, 1.08. 1 means the stock moves with the market. Beta is a measure of volatility. So their cost of equity, and we use a CAPM, capital asset pricing model, to figure that out, is 10.61%. So now that we have the cost of debt and cost of equity, we just apply it to the weight of their debt, which is 13% of the capital structure is debt and 87% of the capital structure is equity. And then we get a blended WACC of 9.63%. And that's how much we have to discount the future free cash flow by to figure out the value of the company. So we estimated the free cash flow for 4 years, and then we get a terminal value, which is the future value after that point. And then we present value back to today's dollars. So the value of Disney, according to our model, is $90 billion. And if you divide that by the shares outstanding of 1.8 billion, the share price is $49.91, $50, and they're trading at 117. So they're trading at a pretty big premium. So in this model, it wouldn't be a buy. You wouldn't buy it. Of course, you have to look at other factors also to figure out if you would buy Disney or not. Disney, but even the past few months, it's never really gotten down to 50. It's always traded at a premium according to its intrinsic value. So hopefully you liked the video. Thanks.